Hi everyone, this is Dr. Pradeep Reddy, Associate Professor, SAYS University, Bhopal, bringing out to you a video on marginal costing. Many of the viewers are asking about, we want to know about marginal costing, and let us have a discussion with regarding the marginal costing, what it is, how it is, and what is the use of marginal costing. By looking into it, let us see what is the definition and the meaning of marginal costing. Marginal costing is defined as the amount of any given volume of output by which aggregate cost can be changed if the volume of output is increased or decreased by 1 unit. Here, it is at most very important concept in production aspects. When companies have decided the amount of output to be taken out, so in that in order to decide the price, what we have to fix it based on the amount of sales that we have to get, we should know what is the production, what is the volume of output that we can get it. So that marginal costing will be helping us in finding out the aggregate cost of producing an unit. So marginal costing is a technique of controlling by bringing out the relationship between profit and volume. Say for example, when the volume is high, you can expect high profit. If the volume is low, you can expect low profit or less profit. So in the same context, let us see what is the concept of marginal costing. It is also known as variable costing because it is based on the behavior of costs that vary with the volume of output, and it generally classifies it into two, like fixed cost and variable cost. So what is fixed cost and what is variable cost is? Fixed cost is the expenditure which remains the same irrespective of output, and it may include like building rent, insurance, and others. For example, whatever may be the number of members living in a house, the rent will be paid in a common aspect. So fixed cost will be constant irrespective of the output. So second one is the variable cost. As the name itself suggests that it is variable, it changes according to the volume of production, such as the cost of raw material. For example, you have went to the vegetable market to purchase vegetables. This week, you will be having a discriminational pricing of the products when compared to the pricing of the vegetables that will be available next week or the previous week. Since they are variable, automatically you have to see the cost at which why they are varying. So the importance that has been given in marginal costing is the variable costing. So here it is directly proportional to the volume of production. So that's why the raw material cost and the labor cost which is included has been given a due importance in marginal costing. And let us see the features of marginal costing, like a fixed cost and variable cost. Only variable costs are considered to calculate the cost per unit of a production and cost controlling, and it shows the difference between sales and variable cost known as contribution. So contribution is one of the important aspect in marginal costing, which we also have to understand what is contribution, how we derive contribution. In our next slide, we can know what is this contribution. And the next features are fixed costs are calculated in marginal costing as they are expenses belonging to profit and loss account. And it is a useful technique for export firms because all the export firms can fix their pricing based on the outputs. If they doesn't know the actual raw material cost and the labor cost, how can they fix the price of the product? So marginal costing helps them. So selling price is determined on the basis of marginal cost. Whatever may be the extra unit that is to be produced, what is the cost associated to produce that extra unit is marginal costing. And with relating to the advantages of marginal costing are, it's a constant nature of marginal cost. Pricing decisions can be taken, determination of profits can be taken, done, and fixing responsibility. So that your output of production can be constant irrespective of the size of the product, nature of the product, and the quality of the product, so that you can come to some conclusion what should be the cost to the product. So that's why marginal costing helps us. And the other advantages are you can control the cost, you can report costing. At the end of the day, you should know what is the, for example, you went to the market and you want to know what is the expenditure that I have made today. You should have an accountability. So for that accountability here also, what is the cost that we have made to produce this product, we should know that. So for that, marginal costing is helping and helps in determining break-even point and decision making. How much amount of sales to volume of production we should meet can be known through break-even. That can be known through marginal costing. And when we look into the limitations of marginal costing, it is difficult to separate fixed and variable cost to some others extent. At certain firms, when we are producing according to the batches and we have given an order of make or buy decisions, when we go for buy decisions, we cannot know what is the fixed cost and what is the variable cost. So in that context, it is taken as a limitation and it is overemphasis on sales. And because sales are at the end of the day dependent on it, and fixed costs are ignored and not suitable for long run to huge industries like big industries. And the other limitations are lacks efficiency in cost control and not applicable to contract costing, and ignores fixed cost in valuation of stock that is on work in progress and finished goods, and not recognized by income tax authorities is one of the important aspect of limitation of marginal costing. And I just want to, in the previous slides we have touched the aspect of contribution. So what is this contribution is, in a simple words, sales minus variable cost. What are sales? We know that. And what is variable cost? What do you derive after deducting sales? After deducting variable cost from sales is the contribution. So what is that is? Contribution is the profit before adjusting fixed cost. So in order to give a simple example, you can see in here, we have a sales of 1000, cost per unit is 10 rupees, and we have a variable cost of 400 and the cost per unit is rupees 4. So the contribution will be 600 and the contribution per unit is 6 rupees. So after deducting the fixed cost, we will be deriving profit. So suppose fixed cost is 300 and the cost per unit is rupees 3, the profit is 3. So at the sales out of 10 rupees here, if you look into the variation of it, when we are selling the product unit at 10, the variable cost is 4 and the fixed cost is 3 rupees. That is 7. So altogether, we are having a profit of 3 rupees. So this is called as marginal cost. Can be used, contribution can be known through this. And this is how marginal costing, marginal cost income statement helps us to understand the firm, whether it is in profit or loss, so that we can decide the amount of production and these sales. So I hope everyone have understood about the things about marginal costing. Thank you, everyone.